Most people think they lose money in stocks because they do not know enough. That is not usually the real reason. Most people lose money because they walk into the market with no filter at all. They let the news tell them what matters. They let price tell them what is good. They let other people as prophets tell them what is urgent. They let fear tell them when to sell. They let greed tell them when to buy more. Then they call the result investing. I have spent my life doing almost the opposite. I do not start with excitement. I do not start with a chart. I do not start with what is popular. I start with a filter. If you do not build that filter, the market will reach into your head, borrow your emotions, and use your own money against you. That is what most people never understand. They think the stock market is a place where intelligent people make predictions. It is not. The stock market is a place where disciplined people refuse confusion. That difference is larger than most people can imagine. A great many investors believe they have a stock problem. What they really have is an attention problem. They are looking in the wrong direction. They watch a stock rise and assume the business must be strong. They watch it fall and assume something must be broken. They hear a YouTube channel mention a company 3 times in 1 week, and by the 4th mention it feels safe to buy. By then the move is often already behind them. The market does not reward people for hearing the story last, it taxes them for it. That tax is not printed on a statement. It is paid through bad entries, weak conviction, emotional exits, and years of wasted compounding. If you want to know what separated me from the average investor, it was not some magical ability to predict the future. It was that I never agreed to let price act as my teacher. Price is a signal. Sometimes it is useful, sometimes it is absurd. But by itself, it is never wisdom. When I was younger, I learned something that kept proving itself over and over again. If you look at a stock before you look at the business, you have already handed control of your judgment to the crowd. And the crowd is nearly always late, emotional, and expensive to follow. That is why so many people repeat the same cycle for years. They hear a stock is moving, they buy because movement feels like evidence, it drops. They get uncomfortable because the only thing they really trusted was the movement itself. Then they sell later, the stock recovers. Now they feel foolish, so they either chase back in or swear off investing entirely. This is not a rare mistake. It is the default path of anyone who enters the market without a filter. I want to tell you something that sounds simple but changes everything. Once you really absorb it, when you buy a stock, you are not buying excitement. You are not buying a story. You are not buying a line on a screen. You are buying a slice of a business. If that sentence does not feel real to you, then the market will always be more dangerous than it needs to be. Because if you do not think like an owner, you will react like a spectator. And spectators are always at the mercy of noise. That identity shift matters more than any trick. The great divide in investing is not between experts and beginners. It is between spectators and owners. A spectator asks, "What is this stock doing?" An owner asks, "What is this business earning?" A spectator asks, "Why is everyone talking about it now?" An owner asks, "Why will this company still matter 10 years from now?" A spectator needs action to feel intelligent. An owner is willing to sit still and let the math work. Everything I am about to say comes down to that one distinction. Over the years, I developed a way of looking at companies that stayed remarkably constant. Even while industries changed, technology changed, and fashions in finance came and went, I did not need 100 indicators. I needed a clean filter, not because the world is always simple, but because investors get themselves into the most trouble when they pretend complexity is proof of depth. The first part of the filter is what I call the earnings engine. A company must be able to turn capital into profits with real efficiency. That sounds obvious, but you would be surprised how many people buy stocks without checking whether the business is truly productive. They buy because the product is visible. They buy because the brand is familiar. They buy because everyone around them acts as if popularity and profitability are the same thing. They are not. A business can be famous and still be mediocre. A business can be trendy and still destroy shareholder value. A business can look powerful from the outside while being fragile on the inside. The numbers do not tell you everything, but they tell you where to start. Asking honest questions. Imagine you open a small fried chicken stand with your own money. You put in $1 million of your own capital, and 1 year later you earn $150,000. That means your capital produced 15%. Now we are speaking the language of productivity. Capital went in, profits came out. The machine did useful work. That is what I want to see in a company. Not occasional luck, not one dramatic quarter. Not an accounting trick that flatters the surface. I want evidence that the business itself converts capital into earnings with unusual consistency. When a company can do that for years, it usually means something important is protecting it. Maybe it has a powerful brand. Maybe it owns a distribution network others cannot easily replicate. Maybe customers are locked in by habit. Maybe the cost advantage is so strong that competitors never quite catch up. I have long described that protection as a moat. People repeat the word so often now that they forget what it means. A moat is not a slogan. A moat is the economic reason your profits do not collapse the moment somebody notices you are making money. That is what separates a real business from a temporary success. If there is no moat, high returns invite attack. If there is a moat, high returns can persist. Think about a stand sitting at the only useful exit of a subway station competitors may want in, but there is nowhere to stand. Location itself becomes protection. Business works that way more often than people think. Coca-Cola has that kind of protection in human form. People do not merely consume the liquid. They inherit the habit, they recognize the brand, they trust the familiarity, they reach for it without needing to run a spreadsheet in the aisle. That kind of behavior is worth a great deal because it creates repeatability, and repeatability is what turns a stock from a bet into an asset. But here is where the first trap appears. A company can make its earnings engine look stronger than it really is by leaning heavily on debt. This is what I call the debt mask. Debt can make an ordinary business look extraordinary for a while. Go back to the fried chicken stand. If you use $1 million of your own money and earn $150,000, that is one thing, but if you still put in $1 million of your own money, borrow $4 million more, build a much larger operation, and then earn $500,000, now it looks as though your own money produced 50%. At first glance, that seems magnificent. In reality, it may simply be borrowed fragility wearing the costume of brilliance. When times are good, leverage flatters. When times are hard, leverage exposes. Interest does not care whether customers walk through the door. The bank still expects its payment. And when revenue falls, heavily indebted businesses discover that strong numbers from last year were never real strength at all. They were borrowed momentum. That is why I have always cared not only about the quality of returns, but also about the balance sheet beneath them. A high return on equity without context can be a trap. A high return on equity supported by a durable moat and sane debt levels is something else entirely. You cannot trust a number until you understand what is holding it up. That single principle would save many investors from years of disappointment. Whenever you see a business with dazzling profitability, your next question should not be admiration. It should be anatomy. What produced this result? Brand power, cost advantage, network effects, regulatory protection, or borrowed money? Those are not academic questions. They are survival questions. The second part of the filter is what I call the price gate. Even a wonderful business can be a poor investment if you pay too much for it. People struggle with this because they confuse quality with permission. They think once they identify a good company, the job is done. It is not. A great company at a foolish price can give you foolish results. If someone tried to sell you a single phone for $10 million, you would laugh. The product may be excellent. The price is absurd. Stocks are no different. When you buy a stock, the company may be marvelous, but the return you earn still depends on what you pay. This is where simple valuation measures become useful. Not because they are perfect, but because they force you to connect price with economic reality. If a stock trades at 100 and the business earns 10 per S-share, then you are paying 10 times earnings. In plain language, if earnings stayed flat and all of them belonged to you, it would take about 10 years to earn back the price. That is a rough way to think about the price to earnings ratio. The lower the number, the quicker the earnings cover what you paid. The higher the number, the more future growth is already being assumed on your behalf. But numbers by themselves can be seductive in dangerous ways. This is where the third mechanism matters. I call it the cheapness mirage. A stock can look cheap for the same reason a damaged house is cheap. Not because it is a bargain, but because something about it deserves caution. Sometimes a company reports a very low price to earnings ratio because profits were temporarily inflated by a one-time event. Perhaps it sold real estate, perhaps it booked some unusual gain that will not repeat. For 1 year, the bottom line looks swollen. The stock appears ridiculously cheap. An investor who only scans the surface says, "How can I ignore this?" The answer is that you ignore it by asking what part of the earnings came from the actual business. Operating profit tells one story. Net profit may tell another. If operating performance stayed ordinary while final profit suddenly exploded, you may not be looking at a bargain at all. You may be looking at accounting smoke. The same danger appears with price-to-book ratios. People see a company trading below book value and immediately imagine free money. They assume they are buying $1 for 50 cents. Sometimes they are. Many times they are buying assets. Nobody wants at the values accountants once assigned to them. A declining industry can carry factories, machines, and land on its books at numbers that have little relationship to what those assets would fetch in the real world. Used equipment in a dying business is not treasure just because it is expensive on paper. That is why low valuation is not an answer. It is an invitation to investigate. This is what I mean by the price gate. You do not ask whether the stock looks cheap. You ask why it looks cheap. That question has saved me far more money than enthusiasm ever made me. The third part of the filter is what I call the holding test. Can this business be owned, not admired, for a very long time? That question wipes out an enormous amount of noise. People speak constantly about what might work over the next quarter. I have always found it more useful to ask what still makes sense over the next decade. If I would not want to own a stock for 10 years, I have no business owning it for 10 minutes. That sentence is quoted a lot because it is easy to remember. It is harder to live by because it forces you to face how little of the market truly deserves long patience. Long-term ownership requires more than current profitability. It requires durability. Will people still need the product? Will the industry still be standing? Will the economics still make sense? Can the company keep sending cash back to owners or reinvesting at high rates? Dividends matter here, not because every great business must pay one, but because dividends reveal something about the character of earnings. When a company can pay cash to shareholders year after year, and better yet raise that payment over time, it is often telling you that the business is not merely profitable on paper, it is generating real surplus. Coca-Cola has been an extraordinary example of this for me. When I bought it in 1988, the immediate yield was not the whole story. The real story was that the business had room to keep raising the payout for years, and that the human habits surrounding the product were so steady that time itself became an ally. That is what people miss when they look only at starting yield. They ask, what percent am I getting today? A better question is, what kind of business will be paying me 10, 20, or 30 years from now? And what might those payments become? This is where compounding becomes something more than a chart. It becomes a relationship between quality and time. But yield, like valuation, comes with its own trap. I call this one the yield costume. A very high dividend yield can be the market's way of warning you, not rewarding you. If the price has collapsed while the dividend has not yet been cut, the yield will look enormous. An uninformed investor sees a gift. A disciplined investor sees a question mark. Can the business really afford this payout? Has it paid steadily for years? Is the dividend growing or shrinking? What share of earnings is being distributed? Is management feeding shareholders from healthy profits, or straining to preserve an image it cannot maintain? A company that pays out everything it earns leaves itself little room to invest, adapt, or protect itself. A payout ratio can tell you whether management is being generous or desperate. That distinction matters. You do not want a dividend that flatters your screen today, but vanishes under pressure tomorrow. You want a business whose cash generation is so sound that paying owners is part of its natural rhythm. By now you may notice something important. This way of investing does not begin with excitement. It begins with elimination. I spend less time asking, how do I get rich quickly? I spend more time asking, what can I safely refuse? That is the true purpose of a filter. It saves you from what you do not need. The fourth mechanism is what I call the report card reality. A great many investors try to skip this part because it sounds dull. They do not want to read the statements. They do not want to compare the income statement with the balance sheet and the cash flow statement. They want an easier story. The market punishes that laziness in ways that are often delayed enough to feel mysterious. A company can show profit and still be sick. Revenue can rise while operating profit falls. That means the machine is selling more but keeping less. The core business may be deteriorating under the surface. A company can report net income while cash does not arrive. Maybe sales were booked, but customers have not paid. Enough of that. And you get the grotesque situation of a company that looks profitable yet starves for cash paper success. Real weakness. The income statement tells you whether the business appears to be making money. The balance sheet tells you how much strain sits underneath it. The cash flow statement tells you whether reality is matching the accounting. I have always liked businesses where all three tell a coherent story. Revenue rising, operating profits healthy, cash arriving, debt manageable, no need for heroic explanation. Once you need a long speech to explain why ugly financial statements are secretly beautiful, you are usually too close to the edge. Investors do this to themselves all the time. They fall in love with the narrative first and begin justifying the numbers. Second, that is upside-down investing. The numbers will never give you perfection, but they will often give you warning. And warning is enough. The fifth part of the filter is industry durability. This is where many good-looking ideas quietly fail. A company can pass the earnings engine, it can pass the price gate, it can even pass the holding test on paper. Then the world shifts under the industry. Kodak is the classic lesson. For a time, the company looked exactly like what many investors say they want. Recognizable brand, profits, reasonable valuation, established position, and yet the future it was built for began disappearing. Digital photography changed the economics of the business, while management hesitated, in part because protecting the old profit stream felt more comfortable than embracing the new threat. That hesitation was expensive. People sometimes ask why I stayed cautious around certain technologies for so long. The answer was never hatred of technology. It was humility about predictability. I prefer businesses where the next decade is not an act of science fiction. I like human habits, I like necessary services, I like products and systems that do not require me to guess which innovation will still dominate after 10 years of competitive attack. That is why insurance makes sense to me. That is why consumer staples make sense to me. That is why businesses with durable demand appeal to me. The future will always surprise us, but some parts of it are less surprising than others. People will continue to eat. They will continue to insure things they fear losing. They will continue to consume certain simple products, regardless of what fashion says. Predictability is not exciting. It is profitable. This entire framework eventually produces a very uncomfortable truth for most investors. The best opportunities do not usually arrive with social approval. They arrive when patience has already exhausted other people. In 2008, when financial fear was spreading everywhere, most people were not searching for value. They were searching for exits. That is when structured investments in companies like Goldman Sachs became possible on terms that reflected fear rather than calm appraisal. People looking only at headlines saw danger. People looking at the underlying economics saw a negotiable price attached to temporary terror. That is why I have said for years that you should be fearful when others are greedy and greedy when others are fearful. It sounds clever when repeated at a dinner table. In practice, it is difficult because it requires a prepared mind. You cannot become rational in the middle of a panic if you were lazy before it began. Courage in markets is usually rented in advance through study. That is another difference between owners and spectators. Spectators wait for emotion, then improvise. Owners prepare principles, then act when emotion misprices something. That is why reading matters. People sometimes joke that I spend my day reading. The joke is accurate. Without study, there is no conviction. Without conviction, every price movement feels like a personal referendum on your intelligence. Without conviction, you become easy to shake out, easy to lure in, easy to trap. Most investors are not defeated by the market's complexity. They are defeated by the weakness of their own reasons. A man with shallow reasons cannot survive deep volatility. He buys because the stock is going up. Then the stock goes down. Now his reason is gone. He buys because somebody credible sounded confident, then a different person sounds more convincing. Now his reason has changed. He buys because he wants action, then action punishes him. Now he calls the market irrational. The market may be volatile. It is not confused. The investor is. This is why I keep coming back to the owner identity. When you truly understand why a business is valuable, a falling stock price does not instantly force you into panic. First, you ask whether the business itself has changed, if earnings power is deteriorating, if the moat is shrinking, if the balance sheet is weakening, if the industry outlook is dimming, then yes, selling may be the rational choice. But if the business remains solid and the market is simply collapsing under broad fear, then a lower price may be a gift rather than an insult. That distinction is everything during the pandemic decline. Many businesses were sold as though the whole economic world had permanently ended. Some businesses truly were impaired. Others were simply being dragged down by indiscriminate panic. You need a filter to know the difference. Otherwise, every crash feels the same and every rebound feels random. Now let me say something many people do not want to hear. Doing nothing is often a major part of investing well. There is no rule requiring you to swing at every pitch. Cash is not stupidity. Waiting is not weakness. Inactivity in the absence of opportunity is not laziness. It is discipline. A great many investors destroy perfectly decent results because they cannot bear the emotional discomfort of unoccupied capital. They feel they must always be doing something that urges expensive. When I waited on Apple for years before buying in size, I was not demonstrating indecision. I was respecting the difference between admiration and purchase. A good company is not automatically a good buy today. The filter must still clear the price gate, and when it did, the opportunity improved. This is what most people reverse. They think action creates opportunity. In reality, patience often uncovers it. Let me give you the final picture. Most people enter the market the way tourists walk into a carnival. They follow the lights, they trust the noise, they go where the line looks longest, they assume popularity is proof, they pay too much, they leave with less than they brought. I have always tried to enter the market like a buyer of whole businesses. First, I ask whether the machine earns real money. Then I ask whether debt is disguising weakness. Then I ask whether the price leaves room for a sensible return. Then I ask whether the business can survive time. Then I ask whether the industry itself still deserves confidence. Then I read enough to know whether my conviction belongs to me or was borrowed from someone else. Excitement. Only after all that do I consider action. That sounds slow. It is slow. That is one reason it works. Speed makes people feel modern. It rarely makes them rich. You do not need to know everything. You do not need to chase every wave. You do not need to have an opinion on every stock. You need a filter strong enough to keep stupidity out. That is a much more practical goal. And once you have that filter, investing begins to feel very different. You stop asking which stock will make you rich next month. You start asking which business you would still feel comfortable owning if the market closed for years. You stop reacting to attention. You start measuring economics. You stop borrowing conviction from headlines. You begin building it from understanding. You stop thinking like a gambler with a screen. You begin thinking like an owner with standards. That is the real transformation. Not amateur to professional, not poor to rich, spectator to owner. If you never make that shift, the market will keep pulling you through the same humiliating cycle. You will buy what is already expensive because popularity made it feel safe. You will sell what is temporarily cheap because fear made it feel dangerous. You will call noise information and call impatience instinct. And one day you will look back and realize you did not lose money because the market was impossible. You lost money because you kept walking through a gate that should have filtered you. So here is the test I would leave you with before you buy any stock. Ask yourself whether you are buying a business or borrowing a mood. If you cannot explain in plain language how the company makes money, what protects its profits, why the price is reasonable, what the balance sheet is carrying, why the industry should still matter a decade from now, and what would make you sell, then you are not investing. You are volunteering to be educated by pain. That tuition is very high. The future version of you will either live off decisions made through a filter or pay for decisions made without one. That is the contract, not with me, with your own capital. And your capital is always listening.